case of individuals, how is the tax jurisdiction handled in the case of digital nomads who have not stayed in a dwelling for more than 183 days? So here, the 183 days rule is the general rule, and it's quite a specific rule, which is interesting. It also depends on jurisdiction by jurisdiction, because some of them also have rules that say it's not only 183 days, but they'll say it's 360 days in a 3-year period, or it would be 90 days for every single calendar year, of which you need to make sure that you also end up with the 360 days over a 3-year period. So there's a variety of rules. So one must go and look at the rules per the jurisdiction that's applicable. But the key considerations for digital nomads include if there's no clear tax residency, and that means the person or the digital nomad doesn't stay in any single country for more than 183 days, they may not qualify as a tax resident under this rule in any jurisdiction. And that's why I say it depends on where the person's staying. Then the question would be, is how do we know where the person's staying? Well, that's why you have a passport and you need to get it stamped. Obviously, we're not dealing with legitimate person. We're not dealing with people that don't make use of passports. Then the permanent home test. So some countries also look at where an individual maintains what they call a permanent home or a habitual abode. In other words, where's your fixed permanent home in a jurisdiction? This can sometimes complicate the issue. And then another test that is used, the Center of Vital Interests process, where an individual center of vital interest lies, and that is determined by economic activities, family ties, personal ties. And they, for example, if they maintain a home, close family or business, that country may claim them as a tax resident, even if the 183-day rule doesn't or isn't met. So that's why one needs to go and carefully consider the country that you, if you want to apply this, that you don't get caught in the so-called gray area, but that you know that there's a level of certainty and predictability to it. Now, the other important rule to be applied are the double taxation avoidance agreements, and they resolve conflicts. And under a DTAA, as it is referred to, there are many tiebreaker rules, and one needs to go and figure out what those tiebreaker rules say in terms of the two jurisdictions where an individual maybe potentially could stay. Why this is important is I know there's some very specific rules between South Africa and Mauritius. Many South Africans go and live and work in Mauritius, and then the question is, okay, what does the rule say? And if it's not clear, and if you can't prove sufficiently that tiebreaker rule, there's a good chance that the South African let's say fiscus might win the battle, and then the individual could potentially be paying tax in two jurisdictions. So there's obviously credits you get back and so forth, but one must be careful, because if you sometimes seem to, not avoid tax, but to manipulate the process and not pay taxes in certain jurisdictions, you could end up paying double taxation. So the other important principle to be followed is looking at the sourcing rules. Now, some countries may still tax the digital nomad's income based on the source of the income, and that's regardless of the residency. In other words, you could be resident in terms of identification and so forth, but you could be externalized, or you could have a tax residency in a country where you're actually not a permanent resident in that country. So there one would look at, if you look at employment income, if a person earns employment income while physically working in a specific country, that country might still tax the income earned within its border, even if the nomad isn't a resident. There's many examples of that, commercial examples. Then business income. If a digital nomad is self-employed and derives income from clients in multiple countries, each country might seek to tax the income sourced from work done within its borders, depending on its local tax rules. And then you have the so-called passive income rule, which is income like dividends, interest, or rental income may also be taxed in the country where the payer or the source of the income is located. So you also got to take this all into account. The no tax residency jurisdiction, that's a difficult one, but that's for people that are constantly moving and not meeting residency thresholds anyway. Now, however, many countries are now more aware of this practice and may still assert a tax based and this will be based on the individual's connections in the country. and the source of income or even personal tax compliance obligations. So, like the US, which taxes its citizens regardless of residence. So one needs to go and look at how this works. There's some special tax regimes for digital nomads. As an example, Estonia has got a digital nomad visa, which digital nomads can stay in the country. They are then only taxed on Estonian sourced income, not their global income. Portugal has got a non-habitual resident regime, and that offers a favorable tax treatment for certain foreign sourced income for a period of 10 years. Croatia has got one where digital nomads can live in Croatia without becoming tax residents or even being taxed on their foreign sourced income. So there's many factors to be taken into account. My recommendation would be is make sure that you determine the tax residency by looking at the rules. You look at the DT, or in other words, the double taxation agreements and tiebreaker rules. You look at the source rules in terms of the countries, and then you also go and look if there's any special rules applicable.